Robinhood's stock is up over 200% in the last year and 85% in 2025. This was a company that was worth under $10 billion at the beginning of 2024, and now it just notched a market cap of over $60 billion. Back in 2021, we never could have seen this coming. Robinhood lost $3.7 billion and suffered a reputational crisis many thought it could never bounce back from. So what's changed about this company? Well, the brash entrepreneur who made stock trading free and once had his reputation torn to pieces has reinvented himself as a masterful public market CEO. Robinhood co-founder and CEO Vlad Tenev has not only learned to make the app he started a profit machine, but he's made it dead clear he doesn't want to run a stock trading app anymore. He wants to build $1 trillion financial super app that can compete with the likes of JP Morgan. In Q4 earnings, Vlad said he sees Robinhood enabling anyone, anywhere to buy, sell, or hold any financial asset and conduct any financial transaction. And this vision, it's already starting to work. One of Vlad's biggest advantages might be how he still runs Robinhood like it's a startup. The company's been shipping new products like a team of 3 engineers in a Silicon Valley garage. Retirement accounts with an unprecedented 3% match are making traditional brokers sweat. Next, a stainless steel credit card where your cashback automatically becomes investments. Don't forget prediction markets that let you trade on everything from election outcomes to March Madness scores. Even the promise of AI-managed portfolios that'll bring institutional-grade analysis to your smartphone. But here's the trillion-dollar question I'll be exploring in today's video. Can Vlad connect all these disruptive products and evolve Robinhood from a gambling app into the hub for your financial future? Before we dive into this one, a bit about me and this new YouTube channel. My name's Sikand. I built one of the biggest business news brands on social media and sold it to Morning Brew at age 22, becoming one of the youngest on the Forbes 30 under 30. I've told the stories of thousands of businesses, but with this brand new channel, I'm only going to focus on the hottest public companies, helping you to understand where they are now and where they're going. If this sounds exciting to you, hit that subscribe button now for the best public company breakdowns on YouTube. Robinhood's founding story was nothing but a masterclass in entrepreneurship, focused on an underserved demographic with a better product. For Stanford math grads Vladimir Tenev and Baiju Bhatt, that meant offering retail investors commission-free stock trading in the palm of their hand. To them, the status quo of investing was almost insulting. Your average trader was paying up to $10 per trade while hedge funds were executing them for almost nothing. It was time to tip the scales, the same way Robinhood did for poor villagers controlled by medieval tyrants. Now, what was most important about this idea is that Vlad and Baiju weren't going to set fire to money giving you free stock trades. They'd spent years building software for hedge funds, so they knew how to make commission-free trading profitable through payment for order flow. I won't dive too deep here because there are better resources you can find to learn more about payment for order flow, but here's the gist. Robinhood sells the responsibility of placing your trades to high-frequency trading firms. They profit off the tiny price differences between what you paid in the app for a stock and what they can find in the market. The radical but simple promise of commission-free trading made Robinhood's product viral before it even released. Nearly 1 million people joined their waitlist, and when the app launched in 2015, it was everything traditional brokers weren't. A better user interface, mobile-first functionality, and of course, no barriers to entry. The platform's accessibility unlocked growth in the millions of users, bringing a new generation of investors into the market. Giants like Charles Schwab would be forced to follow suit years later and slash commissions on their trades. The investing landscape was forever altered. In 2021 came a stunning reversal of fate. Vlad Tenev went from the hero to the villain of the retail trading world almost overnight. He'd made the call to have Robinhood prohibit buys on GameStop stock at the peak of the short squeeze led by retail investors. Millions of users felt betrayed, accusing Robinhood of siding with Wall Street to protect hedge funds like Citadel, while the retail investors they set out to empower were left holding the bag. It wasn't just users who came after him, though. Politicians grilled him, Elon Musk interrogated him live, and former SEC Chairman Gary Gensler decried the payment for order business model as an inherent conflict of interest. When the drama cooled down, Vlad began piecing together a comeback. User outrage aside, Robinhood still had the best product for retail traders, and it was sitting on billions under management. In Vlad's mind, it became clear disrupting stock trading was just the tip of the iceberg. His new vision was to transform Robinhood from a trading app into the primary financial relationship for an entire generation. Not just where you trade stocks, but where you bank, save, borrow, spend, and plan your financial future. This idea was a direct assault on the traditional financial system, and in the past year, we've really seen Robinhood start to unload their weapons. The Robinhood Gold Card represents the company's first major push past investing. On the surface, it might seem like another cashback credit card, but really, it's a customer acquisition machine wrapped in gold stainless steel. The perks are aggressive. 3% cashback on every purchase category with no complicated rotating categories to track. For context, most premium cards offer 2% cash back and charge hefty annual fees. Robinhood charges nothing if you're a Gold member, just $5 a month for their subscription. But the interesting part about this product is that your cashback flows into your investment accounts. The idea is you spend, you invest, you earn, all without thinking about it. Within weeks of launching the card, Robinhood acquired 200,000 cardholders, an impressive way to validate the strategy. Robinhood's retirement strategy might be even more disruptive than the card, though. Traditional brokers offer 1% IRA matches if they offer anything at all. Robinhood, on the other hand, offers 3% for Gold members with no caps on rollovers. For example, if you rolled over $100,000 401k, Robinhood immediately deposits $3,000 into your account. Of course, Robinhood's going to lose money on this strategy, but the LTV here is insane. I mean, these are 30 or 40-year relationships. Now we got to get to the fun stuff with prediction markets. Through a partnership with Kalshi, Robinhood started letting their users trade on real-world outcomes like event contracts for March Madness games. It could go further than this, though, like who wins elections, where inflation lands, and whether specific teams will make the playoffs. According to Vlad, this new side of the investment market has already seen 1 billion contracts traded in just 6 months, generating a 20 million annual revenue run rate. Vlad has gone so far as to talk about prediction markets by calling them the future of news, arguing that market prices provide more accurate predictions of what's coming next. Of course, in 2025, we can't leave out any discussion of AI. Robinhood's AI product, Cortex, will provide real-time analysis of why stocks are moving, help users build option strategies, and will essentially democratize the kind of research that used to cost thousands per month from Bloomberg terminals. These products we're talking about, though, they're not isolated one-off use cases. They form an interconnected flywheel. Have retirement accounts, let AI optimize your strategy. And if you need to hedge your portfolio, just trade prediction markets and don't bet on the New York Knicks. Vlad is trying to build an ecosystem designed to increase customer lifetime value with every new product adoption. And the data, it says it's doing exactly that. Robinhood has only recently learned to print money after years of losing it. Its post-IPO period was brutal. In 2021, they reported a staggering net loss of $3.7 billion. 2022 saw smaller losses of $1 billion, but 2023 still showed red ink with $540 million in losses. The stock price reflected the struggle for profitability, cratering to an all-time low of $6.81 in June 2022. To many, this was the classic growth-at-all-cost fintech stories that investors were sick of, especially as interest rates started to rise and profitability became more important. That's why Robinhood's comeback last year feels nothing short of spectacular. Total revenue exploded 58% to $2.95 billion, but the real shocker was the bottom line, $1.41 billion in net income. Robinhood went from losing $500 million a year to making $1.5 billion a year. That's insane. The fourth quarter of last year was particularly impressive, with revenue up 115% year over year and net income increasing over 10x. When companies beat analyst expectations by a few percentage points, it's considered good. Robinhood nearly doubled them. Q1 of this year continued this momentum as transaction-based revenues surged 77% to $583 million, driven by a perfect storm across asset classes. Crypto revenue doubled to $252 million as Bitcoin rallied. Options revenue jumped 56% to $240 million as market volatility returned. Even boring old equities grew 44%. But one interesting metric is Robinhood's growing net interest revenue. This is the steady money the company can make from customer cash balances, even if a lot of trading isn't happening. And it grew 14% to $290 million. The key metrics paint a picture of a company finally achieving the scale investors hope for. Overall, Robinhood now serves 25.8 million funded customers, managing $221 billion in total platform assets. But the quality metrics might matter more than the quantity metrics. Robinhood's multi-product strategy appears to be helping them make more money than ever from each individual customer. Average revenue per user jumped 39% to $145, showing they're extracting more value from each person. The company's 3.2 million Gold subscribers, which are up 90% year over year, represent their highest value customers who trade more, hold more assets, and increasingly use multiple products. And all these people are contributing $60 a year straight to the bottom line with their subscription. But a lot of investor hype is based on forward-looking projections, and Vlad is touting a $600 billion market opportunity for Robinhood. He breaks it down into 3 segments: $20 billion for active traders, $180 billion for next-generation wallet share, think credit cards, banking, loans, and then $400 billion for what Robinhood calls the global financial ecosystem opportunity, and that's mainly outside the United States. For Robinhood, the game isn't capturing it all, though. It's just getting a small slice of the massive fintech market. $600 billion, even a few percent of it, can make Robinhood a multi-$100 billion business. But for Robinhood to become the business Vlad wants it to become, it'll have to navigate and outmaneuver the forces that are trying to protect Finance 1.0. This really isn't a novel take. Fintech is also a highly saturated market where Robinhood is still a guppy swimming with sharks. Its business, which is still very much a trading business, which is market dependent, opens it up to more risk than other financial players. On the regulatory side, remember payment for order flow? It drives 75% of Robinhood's transaction revenue, and it's been targeted by lawmakers. Former SEC Chairman Gary Gensler made a point to talk about it, but no serious regulation was enacted. Prediction markets are also a regulatory minefield, facing a litany of challenges to become a legitimate asset class. New Jersey, Massachusetts, and Nevada have already issued cease and desist orders against Robinhood, arguing the prediction markets constitute illegal gambling. Robinhood and Kalshi, on the other hand, are arguing these are CFTC-regulated financial instruments. Whether they're right or wrong about that, prediction markets have a multi-front regulatory war ahead of them. It's also worth noting that Robinhood was recently fined $45 million by the SEC for operational failures, and it just shows the company is still putting its rapid innovation over compliance. Each new product launched by Robinhood is a regulatory risk vector, and their aggressive growth strategy maximizes the exposure. We also just can't forget about the giants in this industry. Charles Schwab manages $8.85 trillion in client assets. JP Morgan's asset and wealth management division has $3.4 trillion. These aren't just struggling incumbents, they're profitable giants with deep relationships, trusted brands, and essentially unlimited resources to compete with Robinhood. And let's be real, they're already copying Robinhood's playbook. Schwab is stock slicing, Fidelity is crypto offerings, and JP Morgan's U-Invest platform is commissionless. Meanwhile, every other fintech app wants to become a super app too. SoFi is building the same vision. Square's Cash App, it's got 50 million users. Chime claims 22 million and recently filed for an IPO for more aggressive growth. The space is beyond saturated and customer acquisition costs are only going to keep soaring. Market dependence also can't be ignored. While Robinhood's efforts to diversify out of trading are showing promise, it's still the core business. And those revenues, they swing wildly with market conditions. For example, when markets turned sour in 2022, Robinhood's revenues collapsed. Gold subscriptions and growing net interest revenue help, but transaction-based revenues still dominate. One extended bear market or period of low volatility could seriously crater the stock. In 1998, Amazon decided it wouldn't just sell books anymore, and Wall Street analysts mocked the idea. Focus on your core business, they advised. Don't try to be everything to everyone. Ignoring that advice made Amazon worth trillions of dollars today. It could be useful to think of Robinhood as attempting the same metamorphosis. Start with one thing everyone wants. For Amazon, cheap books deliver fast. For Robinhood, free stock trades. The next move is to gradually add adjacent services and products, create higher switching costs through convenience, and eventually become so embedded in customers' lives that leaving feels impossible. The opportunity is staggering when you zoom out. Fintech penetration represents only 3% of global banking revenue, meaning 97% of a multi-trillion-dollar industry remains up for grabs. Like I said earlier, Robinhood's multi-hundred billion, even trillion-dollar vision is just capturing a small slice of this. Honestly, traditional financial services are more antiquated than you think even in 2025. Branch networks, paper forms, bankers' hours. Meanwhile, an entire generation grew up expecting everything to work as well as their iPhones. Before I wrap up this video, I think it's worth noting that basically every innovator in finance was written off for its niche roots. Bank of America began as a small bank serving Italians that other banks wouldn't work with. Charles Schwab was mocked as the discount broker that would never attract serious money. And PayPal, that was just an easy way to pay for Beanie Babies on eBay. Robinhood may have started as a glorified gambling app, but if Vlad can bring that same thrill to the most boring parts of our financial lives, he could change a lot more than just stock trading. Thanks for watching this video, and let me know in the comments where you stand on Robinhood's business and if you're an investor. And if you enjoyed this video, make sure to hit that subscribe button for the best breakdowns of public companies.